Thank you very much, Holly. Good afternoon, good morning, everyone. My name is Thomas Delille. I'm a partner in the public policy practice of Squire Patent Bugs, covering a broad agenda of sustainability or ESG-led legislations, both in Brussels and Paris. And I'm very happy to be with you today for this webinar on the EU Omnibus proposals on sustainability and simplification. We will have the opportunity with our experts to cover what it means for your reporting and compliance strategy at a time of important changes. With that, and with no further delay, I will give the floor to my esteemed colleagues to introduce themselves as part of the panel for this afternoon's webinar. Marion, the floor is yours.
Good morning and good afternoon, everyone. My name is Marion Serran. I'm also a partner with Squire, and I'm seated in the Paris office. I'm leading the compliance and white collar practice there, working a lot on CSDDD and CSRD regulations.
Thank you, Marion. Begonia from our London office, expert on ESG.
Hello, good morning, good afternoon. My name is Begonia Folgueira. I'm a director in the London office at Squires. I'm an environmental specialist by background, EU and UK qualified lawyer, and I lead the ESG practice from London.
Thank you, Begonia. And last but not least, Dr. Nora Thies from our Berlin office.
Thank you, Thomas. Good morning and good afternoon from my end as well. My name is Nora Thies. I am a director in the Berlin office. I am part of the corporate practice, though not being a corporate lawyer. I specialize in commercial litigation and arbitration, and with a focus on contracts along the supply chain, and a specific focus on the automotive and medical devices industries.
Right, thank you all. During the webinar today, we will cover the highly discussed recent omnibus proposals from the Commission. But as means of background, time has passed since the EU launched its EU Green Deal in the context of the COVID-19 pandemic at a time of strong demand from both public opinion, but also the market itself for sustainability-led policies. There have been some important achievements in the context of the EU Green Deal, including the flagship initiatives that represent the CSRD on ESG reporting and the CS3D on due diligence within the supply chain, and which will retain all our attention in today's webinar. But since the last elections, the EU Parliament's election in 2024, we witness a paradigmatic shift at the EU level, with the European Union now willing to address what it qualifies as a new and difficult context. It started with some criticism raised by some affected stakeholders. We all remember demonstrations by farmers across the EU. Also, the industry calling for a refocus on rebuilding EU competitiveness. On the top of that, Russia's war of invasion in Ukraine, trade tensions that have been accelerating recently, but also on the topic of ESG or sustainability more broadly, a different approach taken on those topics through various policies across jurisdictions, in what we can now qualify as a period of global regulatory divergence. Overall, there is now a strong emphasis on questioning the effects of regulations such as the CSRD and the CSDDD within the EU Green Deal. We've seen a variety of political declarations since a few months, starting with the Letta and Draghi report on the future of European competitiveness, already referring to CSRD and CS3D as burdensome and resource intensive, with a call to create a more favorable regulatory landscape in Europe to facilitate competitiveness and resilience. On the top of that, EU member states themselves, through the Budapest Declaration, calling for a new European competitiveness deal and calling the Commission to make concrete proposals to reduce reporting requirements by at least 25%. And the EU Commission responding to that new environment with, in January 2025, President von der Leyen's Competitiveness Compass for the EU, a communication on announcement for far-reaching simplification with an announced reducing administrative burden by 25% for companies and 35% for SMEs within the next mandate. To materialize those announcements, the Commission made end of February its first Omnibus simplification proposal, with proposals to amend flagship initiatives such as the CSRD, CS3D, the EU Taxonomy as well, and the CBAM regulation, the Carbon Border Adjustment Mechanism, which will be subject to a dedicated webinar tomorrow. As a result, there is clearly, from a political standpoint, a willingness to simplify and streamline the regulatory framework in Europe. Still, it's quite a balancing act for the Commission, because what has been achieved in the previous mandate of President von der Leyen under the EU Green Deal in terms of objective needs to remain while working on simplification and competitiveness. We've tried to summarize in a nutshell a quite complex and wordy omnibus simplification package, which is an attempt within one piece of legislation, in fact two, as we will see, to simplify through amendments a variety of legislative acts. We have two distinct proposals. One, the so-called Stop the Clock, which is about proposing a postponement of the application of CSRD reporting obligations by 2 years, postponing the transposition of in-member states legislation of the CS3D by 1 year, as well as the entry into force of CS3D obligations by 1 year. A distinct proposal containing some more substantive amendments to those pieces of legislation. The Commission, by distinguishing those two acts, aimed to avoid a situation we had late 2024 with another EU Green Deal legislation on deforestation-free products, to avoid a situation where the Parliament could seize the opportunity of a proposed postponement of an EU act to try to reopen the Pandora box and propose amendment more substantial than the sole postponement. What we will have with the Omnibus package is first a now very likely postponement and a separate debate about amending the content of those legislations. Now, coming to the main proposals of changes made by the Commission in its package, when it comes to the CSRD, beyond the postponement by 2 years, what we have is a proposed change in the material scope of the regulation, meaning that there is a proposed new threshold for reporting companies, which is above 1,000 employees. We still keep the threshold related to turnover of 50 million or a balance sheet of above 25 million. But when it comes to headcount, we are talking about larger companies than what the CSRD currently provides. The CSRD regime would become voluntary for smaller companies with a willingness or a commitment of the Commission to develop some dedicated reporting standards on a voluntary basis, especially for those SMEs which need still to provide information within the supply chain to larger companies which are themselves subject to CSRD reporting obligation. The Commission adopted its reporting standards through the so-called ESRS regulation late 2023, which are so far sector agnostic. The CSRD still provides for the need to have some sectorial specific ESRS. This will not be the case if the Omnibus proposal of the Commission is adopted, meaning that we would stick to sector agnostic ESRS. On the top of that, the Commission is willing to revise the existing ESRS within a 6-month time frame after adoption of the Omnibus package. It would be mostly about removing what is considered less important, to favor quantitative reporting rather than narrative text, provide some clarification on some highly debated reporting standards, etc., etc., and on the top of that, working towards improved interoperability with other reporting regimes. An important feature as well is that although the CSRD was foreseeing the fact that reports which were so far subject to limited assurance by a statutory auditor could evolve toward reasonable assurance, meaning an additional level of scrutiny by auditors, the CSRD would stick to limited assurance in its proposed amended form. Something which was of concern to all interesting stakeholders in the discussion prior to the publication of the proposal was the extent to which the double materiality test would remain. The double materiality is retained in the proposal made by the Commission in the CSRD. Now coming to the CS3D, beyond the postponements we described, the Commission would commit to adopt the long-expected guidelines on the content of CSDDD obligations by July 2026, offering, if in the meantime the postponement is adopted, some time for companies to adapt their compliance strategies to the new time frame and be ready for the actual entry into force of the CS3D obligations. Some important proposed changes. First, whereas the current CSDDD is covering business partners in a broad sense, meaning that due diligence need to cover the supply chain in a very broad manner, the modified CSDDD would be limited to so-called tier 1 suppliers, unless the company has plausible information which could trigger a need to go beyond tier 1. In terms of plausible information, we would be talking about some evidence that maybe a company is just set up to avoid being a direct supplier to a company being subject to CSDDD, about information being communicated, for example, by NGOs of a known actual or potential impact on all the various rights which are covered by the CS3D, etc., etc. Some highly debated aspects of the CSDDD, such as, for example, the EU-wide civil liability regime, would be removed, meaning that it would remain on member states to possibly adopt such regime. And there are some proposed changes on the applicable penalties. So far, the CSDDD is referring to a minimum cap, 5% minimum cap of penalties. Again, this would be left to member states' discretion. Still, beyond those two aspects, the Commission is proposing to rely on the maximum harmonization principle for all the remaining aspects of the CSDDD, meaning that member states would not be able to go beyond what the amended CSDDD would provide, and would not be allowed to do what we call gold plating, meaning an extra transposition of EU rules. Although CSRD and CSDDD are clearly the main legislative acts covered by the Omnibus package, there are also some important changes proposed to the EU taxonomy, at least to the extent to which it interacts with CSRD in terms of reporting obligations for companies which are claiming some taxonomy eligible or aligned obligation. If the proposal is adopted, disclosure would only become voluntary for companies with a turnover below 450 million. There will be an opt-in regime for undertakings with such turnover below 450 million. First, if they claim that their activities are aligned or partially aligned with the EU taxonomy, they should still disclose information on their turnover and CapEx KPIs, but they may only disclose information on their OpEx. Still, if they are not claiming activities, taxonomy-aligned activities, they would not need to report anymore, meaning that the administrative burden will be very different in such situations. On the top of that, there is also a proposal to create a status of partially aligned activities and to report on partial alignment. Beyond that, CBAM is also covered in the package through a dedicated proposal. We have now entered the EU legislative process, which as a principle is a lengthy process. Still, we have two different proposals. The stop the clock one about postponements. We've seen institutions going very fast on that one because there is clearly a willingness to provide some legal certainty to companies, given the fact that we have now entered a phase where companies still need to work on their compliance, as we will discuss in a minute, but need to understand what the applicable framework is. The stop the clock was fast-tracked by the European Parliament with an adoption last week. The Council has also adopted its position on the stop the clock, meaning that we are not just talking about a formal approval by the Council based on the position taken by the EU Parliament, and we can expect adoption and publication by late April, beginning of May, meaning that it is more than likely that CSRD will be postponed by 2 years and that CSDDD will be postponed by 1 year, as just mentioned. Now, what is clearly more contentious and will take more time are all the more substantive amendments. Council and Parliament are acting as co-legislators on that file, meaning they both have an opportunity to amend the proposal made by the Commission, which is just the first step. Although certainly discussions have already started within those institutions to try to seek an efficient process, we can expect a lengthy and highly debated process on something where we see very, very diverging positions between parties within the EU Parliament or between member states at the Council level. Meaning we are talking about likely a process that should last between 15 and 18 months from the proposal of the Commission late February. When it comes to the current positions on the file, EU Commission's proposals are on the table, although as said with some toned-down ambitions when it comes, for example, to the double materiality assessments, which remains in the proposal, showing possibly that discussions happened with other institutions in order to try to seek some early agreements on some aspects. And now there only remains some opportunities for the Commission to input at the so-called trialogue level when the Parliament and the Council will have adopted their position. On the stop the clock, we summarize the situation and the fact that it is now very likely since last week's Parliament's vote. We have seen also that the discussions on the stop the clock was an opportunity within the Parliament for the various parties to start building their position on the more substantive amendments. In particular, since the majority party, EPP, doesn't have the sufficient majority and needs to build a coalition with either center-left and Greens or the more right parties, there have been discussions between the SED and Greens and the EPP to already agree on some aspects of the broader discussion. Now, when it comes to the substantive amendments, if we look at the Council position, there is clearly a general agreement of member states on simplification. Nobody wants to disagree with simplification. But then the devil is certainly in the details. Some member states, such as Spain or Portugal, are very cautious in reopening and the file too far, while other countries, such as France and Germany, for example, are calling for higher ambitions. Some clear and expected points of frictions are, for example, on the civil liability regime. should it still be mandatory and harmonized at the EU level, as well as on the scope of the various legislative acts. When it comes to the Parliament, I describe like the dynamic at the Parliament currently. What we have is a conservative majority plus more rightist parties such as the Patriots and ECR, which are favorable to the proposal and even are willing to expand through amendments. But this would be an unprecedented coalition and quite a fundamental shift in the approach of legislative making in Europe. But if we remain in the more usual traditional coalition within the European Parliament between Social Democrats, Greens and the EPP, we can expect possibly some turning down of the proposals made by the Commission, since SED and Greens are seeing the proposal as going too far and calling for some turning down, meaning that altogether there is no clarity on the way forward, and it is very important to monitor the political developments, because again the Omnibus proposal is just a proposal and the legislative process has only started. Maybe to put things into context, and then before leaving the floor to my colleagues, clearly the question is the extent to which the Omnibus proposal is or not an evidence that the EU is questioning its overall approach to ESG. The first answer to that, and it's a balancing exercise. As said, the same President von der Leyen has been building the EU Green Deal and now needs to work on its simplification toward amendments of some flagship initiatives, meaning that it is very likely that there is both a willingness to achieve the objectives of the EU Green Deal, but still provide some room for simplification and work on competitiveness. At the EU Parliament, we've seen some changes in the majority. Now the real question is the extent to which we would rely on the traditional coalition, or if the EPP will risk teaming up with some more rightist parties. That's a big question mark. At the EU Council level, very difficult to read beyond what we've provided as some very main lines. Still, member states are using the opportunity of this omnibus package to ask to reopen other files. We are talking about the deforestation regulation, some product-specific legislation such as PPWR and packaging, eco-design, but also even chemicals legislation such as the CLP regulation. So it's very much some sort of a wish list so far, and quite difficult to anticipate where this will all go. With that, beyond the political debate, this certainly raises quite some questions when it comes to companies having to comply with an existing framework, and I will leave the floor to the experts on that topic. You're unfortunately on mute, Bego. I think you need to unmute yourself.
There we go. Thank you. Thank you, Thomas. I think the first thing that Marianne and I, who work actively advising clients on corporate sustainability reporting, including CSRD as CS3D, is what is the market saying? Is the market sort of reeling from uncertainty? Are they pro-simplification? And I think it's both, really. There's a huge amount of uncertainty. Clients have been pursuing for 2-3 years CSRD readiness programs, trying to come to grips with these very complex CSRS standards they need to report against. And at the moment, they don't know if they're in or out of CSRD. The scope has changed in the proposal. It's only a proposal, as you say, Thomas. We're seeing a huge amount of negotiation and horse trading with other legislation, which we thought was set in stone. The proposal itself is not very clear. So we know that potentially there'll be, as you said, limited assurance, no sector-specific standards, but materiality remains. And there's likely to be net zero transition plan obligations, because we already have those in the EU. And the reporting options haven't changed. So we spend a very long time advising clients on are you in scope of CSRD, for example? Because the thresholds were really complex when you went to apply it to multinational businesses with different corporate structures. So the simplification has been welcomed. And I think that business has felt a huge regulatory burden placed on them by the legislation subject of the Omnibus simplification package, in what felt like really a manic timescale. It was very difficult to come to terms with what was required by these complex European sustainability reporting standard that covered everything from environmental matters such as resource efficiency, biodiversity, waste, climate change, social standards, and governance of business. But it almost felt for our clients that there was a dilution of the value of CSRD, where businesses were just reporting on a huge amount of data points, where actually what was material to them was very difficult to understand. It became a little less meaningful than initially CSRD wanted to be based on these ESG values. And I think this is where I'm seeing from our clients show actual leadership and from the market as a whole, where they're moving their sustainability reporting programs from just a compliance exercise where they were driven down this funnel, rushed down, into more of a risk-based exercise than just a compliance mandate. And there is regulation and we'll address that as well, that our clients, corporates worldwide will need to comply with. There is regulation, but this regulation was losing its sort of value of transparency and to inform investors and to ensure that businesses are resilient for the future. Clients are focusing on more basic risk principles. How resilient is my business to climate change? How am I going to attract the right people? And what is good governance for my business? So there's a real simplification of CSRD to focus on these risk elements. And there's this pull from governments one way, and we're also seeing on the other side investors pulling the other way. So we've seen pension funds tell asset managers to rethink their recent climate investment policies, where asset managers have been moving away from a lot of net zero commitments. Private equity, we feel, is still pursuing the value-added agenda, and consumers in some countries and businesses are taking a rollback against some of these, the rollback of some of these policies. Marianne, would you like to comment?
Yeah, I think, perfectly in line, of course, with everything that you said. Just to add, from my perspective, I think that we are seeing a transition from clients and from the comments that they are sharing with us. At the very beginning, when we had all the discussion and the noise on the market on what would be this omnibus simplification and whether or not we should stop everything, whether or not we were like all the investment. I mean, the first question was like what I'm going to do with all the investment that was made from date, and people were very worried about what has been done and what they've been pushing internally in terms of budget, in terms of change of the practice and the processes, investment that were done. And I guess that this announcement was made in a form that was creating a lot of confusion and question on the market. Whilst now, I guess that we are transitioning through a calmer period, I would say, where since we have this proposal and since we've seen that like the EU is kind of taking the stance to move quickly and to at least provide some direction as to the deadline and new timeline that would go with those regulations. There is some reassurance and some more certainties as to what we kind of see that would be the future of those regulations. What we know for sure, what we seen and that we were like kind of fearing was that the double materiality assessment was due to disappear very quickly. For now, the understanding is that this is not like a key topic, and this is not to be changed or not to be changed. So people are and companies are kind of focusing on this effort, and as soon as they are in scope and that they know that the business is in scope, there is this long-term investment on ESG that goes with this double materiality assessment that is absolutely crucial. I mean, all the regulation lies on this principle, because obviously if we change that, we change the full purpose of the regulation of the EU Green Deal in general. So I guess that there is a very strong signal in maintaining this double materiality concept as a core point on the CSRD and on the core point of the ESG practice that has triggered more certainties. What we see, I mean, we've seen different situations. Begonia just listed a lot of them. I guess that depending on the market and on what are doing your competitors, we've seen companies which are, for example, major companies acting in France, and under some regulation they cannot submit and to public procurements if they are not like disclosing a lot of information on ESG. So they need to continue the ESG effort. They need to continue the CSRD reporting, although they may not be willing to. I mean, they may not have to. I mean, they will not have to publish the report for next year. So, for example, this is a reason why the ESG and the CSRD work were continued. A lot of we have also examples as well where the debt is financed through where the financing contract of the company lies on some very strong ESG criteria. Once again, the company needs to fulfill this contractual obligation and has to continue the CSRD report. And for those that are in the middle, depending on the industry they are in, depending on the position taken by other big players in their industries, they have aligned differently their efforts, and a lot of them are kind of regrouping, rediscussing the priorities, and adapting the internal roadmap and agenda to what has been to what is to be expected. Because what we know is that there are a lot of key points that will still be there. For example, on all the CSDDD work is based on the OECD principle, and a lot of people were very afraid not to have the same principle actually translated into EU law, which I mean would be a very big step back. So we now have some kind of reassurance. We don't know to the extent to which the full I mean, the tier one will stay, or whether like the extent to which the due diligence will be needed. But what we know is that this change and this omnibus agenda has not changed the EU forced labor. So if the corporates are subject to EU forced labor, then they will still need to continue the work they were doing, or the kind of roadmap they had on this CSDDD initiative. So those are the kind of examples of what we've seen on the market and what kind of criteria that were taken into account by our clients so far to move forward with this omnibus proposal and the kind of uncertainty that comes with it. In terms of what to do, it really depends on the strategy they have on the long-term basis and mid-term basis. Some have withhold part of the work because obviously there is a need to invest if it doesn't comply with, if the purpose is not to comply with a long-term strategy or mid-term strategy, or there is no legal obligation and no push from the market to do that. But ultimately, we see that a lot of factors, perhaps in this middle gray zone where they are really caught by the uncertainty, are kind of really prioritizing the effort and kind of retailoring the effort with what is to expect given their own business and priorities in relation to ESG.
That's very, very interesting. And I think the prioritization exercise is important because it's not certainly not the end of the game, and we are talking about a far broader picture at the EU level. Still, we are talking about also a situation which already currently varies widely between member states. Although we see some member states changing their mind quite quickly. If I take the example of France, having been the first to transpose the CSRD, and now having called late January for a postponement by an unlimited postponement of the CSRD, and then a national initiative for postponing by 4 years, ultimately reduced to 2 years to fit the Omnibus proposal. What does it mean in terms of adapting the strategy when you know that the situation is varies so widely between member states?
I think to take that, Thomas, and as Marianne said, sustainability reporting compliance has not gone away. There's enough environmental legislation. Look at the waste legislation, look at net zero target by 2050, packaging legislation, circular economy, etc. There's enough legislation that's already been implemented at EU level and at member state level that will require compliance. In terms of where CSRD has been implemented, we do have this uncertainty, don't we? And Marianne, you have a perfect example in France there.
Yes, and I think that in France we are kind of in the middle of this gap because we were the first to transpose. There was a bit of a change in the politics in France that have pushed the government and the French authorities to issue this paper in January 20, where they were looking for simplification. If we look at this paper carefully and take a step back from the noise that was on the market, we kind of seeing that the authorities were really seeking for the simplification in a very key point that were missing in the regulation. They were looking to fill the gap as to the uncertainty that was there, and I guess that there is a lot of this is the purpose of the proposal, to kind of fill those gaps as well. So they were pushing for those gaps to be filled, and then they have issued this like the regulation was voted last week as well. So we have now implemented this 2 years postponement in France for the wave 2 and wave 3 companies that were subject to the CSRD. So we are no longer in this uncertainty. We know that and there is a question on that on the Q&A session that I'm picking up now, because I think it's perfectly on this point. The question was, are member states obliged to apply the postponement, or can they go with on with the implementation if they are already implemented the rules into national law? So we were in this position in France where we did have like the legal framework to move forward and effectively apply the regulation. So yet we enacted a regulation that is to postpone the CSRD requirements. It is up, and perhaps some member states may have different laws, but my global understanding of how EU is transposed into member states is that it's up to member states to decide what to do with the postponement. So I guess that we may find a lot of different member states in which have transposed the regulation that will do as the French did, and perhaps will enact a regulation confirming that they will also postpone for the corporates that are subject to the wave 2 and wave 3 regulation. This is to be scrutinized and reviewed, because we don't know exactly how this will fly in every member state, but it's possible that the position the France has just taken might might be duplicated elsewhere. In terms of just two additional comments. France at this stage, so took the liberty to effectively say that the 2 years suspension was enforced. They also took this opportunity to delete the sanction that was applicable under the CSRD, and the fact that the CSRD regime was kind of aligned with what is applicable for the annual reports and for the accounts that needs to be accredited by a financial auditor. So this has been disaligned. We had a criminal sanction that would apply, that has applied in the past. This is no longer the case. This has been voted. The French also clarified what was one of the key questions, which was, do we need to disclose as many information? Like, do we need to go that far? And are we obliged? It was one of the questions we had a lot. Are we obliged to disclose information that may have a very adverse effect on the market, as we will disclose very confidential information, information that could impair our competitiveness on the global market? So the French answered that this is, as long as there is a general consistency within the report and within the information that were to be published, then it is okay not to disclose every information that is subject to confidentiality, and that should kept aside what is on the public report. So those are like what we've done, and I leave the floor to the other jurisdiction to present what was there, for example, in Germany.
Thank you very much, Marion. Nora is with us today. I think Germany is also a very good example of a country which has a highly developed ESG regulatory framework historically. Some laws that have been criticized in Germany as well. And all those developments happened at a time where in Germany we were in a pre-election period. And now that we have more clarity on the new majority in Germany, it would be great to hear what the trends in Germany are, given the importance of that member states for the EU economy and political landscape.
Yeah, thank you, Thomas. The Germans on the call here may remember that while the Christian Democrats were still in opposition, they started an initiative to repeal the Supply Chain Act, which has been enforced in Germany since 2023. That initiative happened last year and it failed. And the expectation, I guess, re-election was a German government led by Christian Democrats would again take the initiative to repeal the German Supply Chain Act, and also take a different role on the EU level in terms of CSDDD and CSRD. But now, given the very difficult majority situation we have, and the very difficult coalition negotiations, it is very difficult to predict at this stage what the Christian Democrats will be able to push through. They're in a really difficult position, actually. So their promise pre-election has been basically the main two topics. They promised we'll make a big change in terms of migration laws and enforcement. Second thing is we'll save the German economy. Now they didn't come out of the election as well as they hoped for, and they don't really have an alternative to a coalition partner, which is the Social Democrats. They were hoping, obviously, to be in a position where they could choose between different coalition partners. And since they have made it very well under no under no circumstances go into a coalition with the so-called alternative for Germany. They kind of have to work with the Social Democrats in the end of the day, which puts them into a very difficult position because they will have to give up, and they've already given up, from what we hear from the coalition negotiations, of the promises they made pre-election. So it is very difficult to predict what, also on the German level, what will come out. The position of the Christian Democrats is clear. They if they were the ones to decide alone, they would just repeal the German Supply Chain Act and try to and probably take a very different position than the still still in power government of Olaf Scholz on the EU level. But we haven't really heard anything in the last days. It's clearly on the table. It's one of the topics. But probably if I had to look into my crystal ball, I would say it would rather come as a surprise if we had a lot of change in terms of national legislation, and probably also on the EU level. But again, we're really in the middle of everything. It looks like, I mean, they kind of promised that the coalition should stand before Easter, which seems like an ambitious plan because it looks they're still pretty far away on very main topics. So we will probably know more in the coming weeks about how much of their promises in terms of really supporting the economy the Christian Democrats have been able to push through in their coalition negotiations.
And the feeling we have in Brussels is that those changes in scope are also a way to accommodate German Mittelstand, those large SMEs, which are very important within the German economy. What reactions do we get in Germany from those companies in terms of how do they welcome the proposed changes as they appear in the Omnibus proposal?
Yes, absolutely. The reactions from the German economy have been pretty clear, especially from what you just said, the famous German Mittelstand, so the SMEs. So the reaction from that economy segment has been very positive towards Omnibus, and they're exercising a lot of pressure to the coalition negotiators to kind of go with the flow and repeal or substantially change the German Supply Chain Act. But then the Social Democrats have already made it clear that they believe that the Supply Chain Act is a success and shouldn't be touched. And so it's really it's two very opposing parties, but the position of the German economy has been very clear, very positive towards Omnibus, and also kind of giving the Christian Democrats support with a view to hopefully even repealing the Supply Chain Act, which again I think would come as a surprise if that was really the result of this process.
No, very interesting. So, thank you very much, Nora. And now jumping to a different situation, different example of member state with Spain. Bego, if you have any feedback to provide on the situation in Spain, what would that be?
Well, I think that Spain was not a supporter of Omnibus. As you said before, Spain and Portugal wanted to keep Omnibus as it was. However, Spain did not manage to transpose any CSRD legislation, although there's been a bill kicking around for 9 months now. The Spanish Parliament is in a very is in a bit of a hiatus. It's trying to approve its budget, but the socialists are relying on a lot of other parties to get a majority. So there's a very fragmented picture in terms of when it comes to approving legislation in Spain. It is very, very difficult at the moment. The socialist government supports corporate reporting sustainability legislation as it's drafted, but we await and see, really, because there's another opportunity at the end of April for the Spanish Parliament to look at CSRD, and hopefully we'll have some sort of announcement. It is a very difficult picture for those companies that need to report in Spain.
No, very interesting. And I was mentioning also a willingness of the EU to work towards interoperability with other reporting standards internationally. And of course, the UK is the closest jurisdiction, with companies really being willing to have the less additional administrative burden if they need to comply with other reporting regimes. How is the Omnibus proposal perceived from the UK? And how does the UK react to this change of this shift in political priorities in the EU on those topics?
Yes. So the UK is providing some sort of stability when it comes to sustainability reporting. Climate change TCFD standards were adopted in 2022. The UK has backed the task force on nature-related financial disclosures. We are, again, which are global standards, and more limited, much more limited than ESRS. And we are now looking at the potential implementation of ISSB standards, again, which are international standards and only based on financial materiality. So UK companies, as non-EU member state, at the moment, they still see that they will have to report in the EU if they have a large presence in 2029. That hasn't been changed by the Omnibus proposal. Where they have EU entities that need to report potentially in 2028. Again, they're running their materiality exercises, looking at their gap analysis. Everything is proceeding as it is. But as you say, Thomas, there's that wording in Omnibus that says we want to align more with international standards. And I think that's where the UK is. There will be this tension between financial materiality in these international standards. For example, ISSB has been adopted in Japan too, so and double materiality in Europe. So it's a little bit of a wait and see.
Oh, great. Thank you. I think that's all very interesting, and it shows all together that we are just at the start of a journey. Hopefully, the stop the clock proposal was adopted quickly in order to give some certainty. Also, it still needs to be formally adopted. It's more than likely that CSRD and CSDDD will be postponed, giving some time for companies now to adapt to, in principle, a rather certain time frame. Also, Marion mentioned it. We are talking about directives, meaning there is a need for transposition in national laws. The devil, again, is certainly in the details, but still, there is something on which to rely on for companies in terms of specific dates from which the obligations should be kicking off. In the meantime, we have opened a legislative process, which is a long process, certainly contrasting with what we currently see in the US, with all the executive orders being adopted daily. We are here in a regular, traditional, and democratic way of lawmaking, meaning that it is a process where we will see a lot of debates. The market will be receiving a lot of information, sometimes contradicting information, all that Marion described as noise on the market, and there is certainly a need to separate the noise from really the real information and a general trend towards a potential amendment of CSRD and CSDDD. there will be some important milestones. We heard yesterday and earlier today that the Parliament is working on a possible vote and first reading by October, with a variety of steps before that, meaning that it's clearly the moment to structure any input in the legislative process through individual representation in Brussels, through industrial associations, etc., really to have your voice heard at the EU level, because that's the moment where you may be achieving some reshaping of the ESG legislative framework. Now, when it comes to compliance itself, I will again give the floor back to my colleagues on that to see if there are some recommendations to give for the months to come and to navigate through this period of 15, 18 months of uncertainty when it comes to the content of CSRD and CSDDD ultimately.
On my part, just to confirm that I guess all is on adapting the roadmap to what will not change, and understanding by doing this regulatory check and compliance gap analysis, understanding what is very key to your organization and what is critical in terms of competitive advantage on the long term that needs to be worked on, and that's to be in the roadmap, and that is where I guess those investments should be done. Keep really reviewing what your competitors are doing and what all the business partners that you are working with are doing is also a very key element, as the ESG market is really structuring around different market practice that are very different based on the industry. And I guess this is also something to keep in mind. And on the long term, like I guess that for the or perhaps the middle term, for the next 18 months, having a very clear understanding of what the other member states will be doing, and reading what is happening precisely, not just on the first noise that are to be being made, because I guess that what we've seen, and it's always something which is very, very good, is that the information that we have on day one of where a decision is taken and published is never the relevant one. I mean, we see that a couple of times, and taking this time to digest those big news that could be complex and that could make time to really reflect properly on what is the impact on your business is very key as well.
I think from my part, I have two things. One is focus on your compliance as it is now. That's essential. There's enough legislation to comply, and how that works within your double materiality exercise. And secondly is to learn some lessons from the reports that have already been published, because don't forget we have reports out there for 2025 for listed entities. And analysis of that really is that these reports, these CSRD or whatever they end up being reports, they are legal documents. They are filed next to your corporate accounts. So they need to be seen in that lens, I think, rather than just as a marketing tool, because they're going to be subject to a lot of scrutiny by investors, but also by others such as activists, and the risks of climate change litigation and shareholder activism, etc., haven't gone away. And then again, to really be aware of, what have you said, and are you doing that right? Have you got a net zero goal? Go back to that, reanalyze that. Can you meet that net zero goal? Can you improve your transition plan? So it's about sort of focusing on what you already have.
Great. Thank you very much for all those insights. I think we are right on time, and we have addressed the question we had on the Q&A. Of course, don't hesitate if you have any question to reach out to any of the panelists that were here today. Thank you very much all for your attention, and we will keep you posted on developments related to these omnibus proposals. Thank you very much. Bye-bye.
Thank you.
Thank you.
Thank you.
Bye-bye.